What's up, everyone? It's Eric with Option Edge, and today we're going to be talking about delta and trying to explain what exactly delta is. So let's hop over to the PowerPoint. All right, what is delta? Learn to trade options. So here's the formal definition of delta by the Chicago Board of Options Exchange. So delta is the amount by which an option's price will change for a 1-point change in price by the underlying entity, which is the underlying entity is stock. So, but yeah, that sounds a little confusing. So let's break it down further with an example. So let's say we have a 90 delta option. Okay, so for every $1 move, in the stock price, the options contract will move 90 cents. Okay, so if you have $100 stock and it goes to 101 and you bought a 90 delta option, that your contract is, if you bought the contract for, let's say, $10, that contract would now be worth $10.90. Let's do it with a 50 delta option as well. So for a 50 delta option, for every $1 move in the stock price, the contract will move in price 50 cents. Same thing with a 10 delta option. With every $1 move in stock price, you will get a 10-cent move in the contract. So if we go a little further, if you have a 10 delta option and the stock price goes from 100, let's say, to 110, so that's a 10-point move. If you had a 10 delta option, the pricing of the option would now be worth $1 more, because 10 times 10 is $1. 10 times 10 cents is $1. And let's hammer this down further with a Tesla example. Okay, so let's say you buy a 50 delta option in Tesla for $10. Okay, Tesla stock is at $700, and then it's at $700, and then it moves up 10 points to 710. Okay, how much is your contract now worth? Answer is 15. So for every dollar increase resulted in a 50-cent increase in your contract. The stock price went up $10, and each dollar move resulted in a 50-cent increment, which yields 5 full dollars. So your contract was originally $10. You add the 5, now it's $15. Okay. So another way to look at delta is to think about it, something called Moneyness. Okay, so if we look over on the right here, on the right side here, this would be a put option delta. Or let's forget about the put, but you see the numbers here. You see 50 is at the money. Okay, so 50 delta will always be where the price of the stock is trading at. So if we go over to Lucid, so Lucid is, I have call options selected. Lucid is almost $24, but right now it's at $23.88. Okay, so it's actually closer. If you look, it's in between the 24 strike and the 23.5 strike. It's technically closer to the 24 strike. So the 24 strike should be very close to 50 delta. So let's open that up and see what the delta is. So it's a 51 delta. And that sort of makes sense. If we open up the 23.5, it's going to be a slightly less delta. Or excuse me, slightly more delta. Okay. So that's 55. Okay. So let's go back. So let's do an example with Apple. You can see we have the call side of Apple. As we go farther up, if we go farther into the money, so if we go decrease the strike price, we're going to have a higher delta. Okay, if we increase the strike price with calls, we're going to have a lower delta. Okay, the opposite holds true with puts. As we increase the strike price, our delta gets or increase this way, our delta gets bigger. As we decrease the strike price, our delta gets smaller. And I sum that up with this slide, calls and moneyness. The higher the strike price, the more out of the money. And that means the more out of the money, the lesser the delta, okay? The lower the strike price, the deeper in the money the call option will be, okay? And the higher the delta will be, okay? So now let's do puts. The lower the strike price, the more out of the money. And the more out of the money, the lower the delta. The higher strike price, the more in the money, and the higher the delta, okay? So another way to look at delta is also delta is roughly a measure of probability. So if you buy a 40 delta option contract, you have basically a 40% chance of that money becoming in the money and having value by expiration. And we're doing an example. Let's say a 30 delta put. We buy a 30 delta put. It should be a winner about 30% of the time. If we sold a 30 delta put, we would expect that we would have a winner 70% of the time, because that means if we sell a 30 delta put, that means that 30% of the time that put will end up in the money, which means 70% of the time that put will end up out of the money and expire worthless. And if you're a seller of options, that's exactly what you want. So yeah, that's my brief little spiel about delta. If you have any questions, please like and comment. That's it. Take care.